This idea is very simply that when the gold is tying in with the dollar, it actually presents a hidden opportunity, because the vast majority of everybody that trades this concept trades gold against what's happening on the dollar. So all the floor traders on gold, it was always about what the dollar was doing. But because of technology, we've got the ability to forecast what the dollar's going to be doing next. And for that reason, we are able to start recognizing some of these opportunities. We're able to start recognizing when it starts making sense. So when we look at the correlation coefficient of the gold market against the bonds, against the 2s, 5s, and against the dollar, we can see it in here. Now, obviously, it's a little bit of a noisy chart. So what I'll do is I'll get rid of some of this. We'll get rid of the p-values at this stage. And we'll bring down the color shading down a little bit as well. In fact, we'll just take the color shading off. That's not taking the shaded areas off. This is taking the shaded areas off. Okay, so that will do us. So this is in fact, that's the one we probably be better keeping, because this is the one that makes a wee bit more sense. Okay, we'll keep that one, and we'll get rid of the dollar one. Take that one off, and we'll take that one off. Okay, so this now makes a little bit more sense. Okay, so what we've got here is we've got the dollar against the 2s, 5s curve. So the dollar against the 2s, 5s curve should be a positive correlation. You can see quite clearly that there are occasions where the 2s, 5s curve is completely in the opposite side to where the dollar is. So on that basis, we should always be recognizing that there is either a gold trade in this chart or there's a dollar trade in this chart. Gold or dollars. Okay, so there's going to be one or the other. So obviously what we're looking for, if it's going to be a gold trade, is we want to see gold trading in the same direction as the 2s, 5s, but because that's wrong. We want to see gold at the same time trading in the same direction as the euro dollar, because that's right. But that means that the euro dollar is giving us this extra confidence that the gold is in the wrong price, because the dollar's in the wrong price. So that gives us a bit more confidence that at a high print or a low print, gold is going to turn around. So take a look at those examples. So for this to be negatively correlated, we need this to go positive. Sounds interesting. But obviously, if we're trading, let me take the dollar off first of all. So this is the 2s, 5s curve. So obviously, for us to trade the 2s, 5s curve against the gold, this should be a negative. This should be a negative correlation most of the time. But when it goes positive, of course, that's pure random chance. In other words, it's abnormal. It's not a normal response to that gold price. Hold on a second. I've got a little bit of a long bond position on, and I'm just taking a bit of money off that trade at this 0.7s. Made some nice cash on that trade. So I don't want to give it all back whilst I'm babbling away here. Okay, all good, all good, all good. Right, so we're looking at these areas here. Now you might be saying, but why have you only marked off 3 of these? Because these are all areas where the dollar is now agreeing with gold. The euro dollar is agreeing with gold. So that means that the euro dollar is helping the gold be mispriced, in other words. And for that reason, it can start, you might be saying, but surely it'd be better if they were all negative. But yeah, the chances of us getting that are slim. Usually gold goes higher because of the short-term, short attention span traders that only trade the dollar against gold. And therefore we end up getting an overpriced gold or an underpriced gold because of the dollar. So when we look at the dollar should be almost identical to this negative correlation that we have on the 2s, 5s. When the dollar's positive, of course, this will be negative, because obviously that's what we're looking for. We're looking for the euro dollar. We're looking for the euro dollar to be exactly the same as gold price, but exactly the opposite to the 2s, 5s. So when we look at this as a narrative, these are the examples I'm looking for. Okay, this is an example that we're looking for. So now you can see the opportunities. You can start to recognize some of these opportunities in these areas here. You can see that what I'm marking is I'm marking off where the white line appears above the 0 print and where the orange line appears almost at 0. at the bottom edge, or -1 rather, at the bottom edge. So you'll see the orange line's at the low, the white line goes above the zero. The orange line is at the low, the white line goes above the zero. The orange line is at the low, the white line goes above the zero. The orange line is at the lows, the white line goes above the zero. In all of those occasions, in all of those locations, the gold price is being driven by the dollar, but the dollar is fundamentally wrong. So if the dollar is fundamentally wrong, the chances are the gold price is fundamentally wrong, and as a result, we've got an early read on this gold. So we start looking in these areas for possible gold reversal opportunities. Let's take a look and see if any of these would have resulted. Now remember, if the gold's trading down, it'll be bullish. If the gold is trading up in these areas, it'll be bearish. Pretty obvious stuff, right? So let's take a look. We can see that the gold was trading down in this area to a day low on the far left-hand side. That would have been a buy trade in gold. This is an interesting one because it's trading up a little bit just into that trigger. So that would have been a sell trade in gold. Didn't do very much. This trade was trading up into that trigger. That would have been a sell trade in gold. And this one's trading up into that trigger. That would have been a sell trade in gold. So you can start to recognize that this ties in beautifully with these triggers for reversals. You can start to recognize how well some of these triggers have done. This one, for example, here, you can see it actually ends up going down into the low price here. This is dropping off down into the low price. Now, obviously, it started to drop off on the way up, and it continued to drop off on the way back down and on the way back up again. So this is a very difficult one to read, but obviously we can get it so that it's quicker to make it more obvious. So this is what we're looking for. You can see that everything seems to be, you know, a little bit upside down here as back to front, and that's something that we can obviously pay attention to. And yeah, I mean, it's just one of those things, isn't it? You might be saying, but I would far rather trade the dollar the dollar 2s5s relationship against gold, but you're not going to get that very often. That's my point. You're not going to get it very often. You might say, but what happens when I do get it? Well, let's take a look. So here's a good example of one that you could have got. You can see that the relationship is very, very obvious. The gold is going up against this narrative. And if you look at the narrative, you'll see, you might be saying, what is that narrative? Well, let's take a look. The inputs. For the inputs, we've got 1 over euro dollar. In other words, it's the US dollar. So this orange line should be the same as the 2s5s. When the orange line is the same as the 2s5s, if it ever goes above the 0 point, where it happens over here, where both of them go above the 0 point on an uptick, that's going to be a solid opportunity to sell sell gold into that as well. So that's when everything is against gold. But if everything's against gold, that's the ones you've got to be careful with, because there may well be some other driver somewhere. So this is an unexplainable trade here. Now, that means that we've just got to be careful with it. It should be the most obvious, but because it's the most obvious, it's also the most dangerous. I don't like obvious stuff. So you see an opportunity here as well. You can see that this drives up, but I can't really see what that trade is. I can't see if that's an up phase or a down phase. It's not into a high. It's just a terrible looking trade. Well, you can see in here that this market starts to become very wrong as this price drops. And it seems to be very wrong as the price dropped down into that phase. And there was a buy-side bounce off of that very wrong phase. Very wrong means gold is going effectively positively correlated to the 2s5s and the dollar. Well, that's not going to last for very long. So we already know that there's a very good chance here that this is going to be a buy-side pop. Now, when the gold agrees, like this situation here, this is going to be a dollar trade, of course. So when we see this situation in this area here, and I'll just draw a big circle in it. When we see that big situation in there, this is suggesting that there's a dollar trade taking place. It's not a gold trade, because the gold agrees with the 2s5s. If the gold agrees with the 2s5s, what the hell is the dollar doing in this location, wherever this location may be? This is an opportunity to do business on the euro dollar. This is an opportunity to start snapping up some euro dollar trade here. Now, obviously, if we want to try and figure out what that euro dollar trade is, we would have to put the euro dollar on the charts to see what the euro dollar was doing in that location. If I now go into compare and put the euro dollar into this as a storyline, you'll see that the euro dollar inside of that little space was on an uptick. Well, not surprising because gold was on a downtick. So is that not a lovely opportunity to sell the euro dollar, guys? Yes or no? Is that not an absolute peach of a pair to sell euro dollars at that top edge? Yes or no, guys? So when I see that hollow opening up that size, that's a euro dollar trade. It's not a gold trade. The gold is an agreement with a curve. That is a euro dollar trade, yes? That's what you're looking for euro dollars. And then when you see that setting up, you can see it's kind of setting up again here, isn't it? On the right-hand edge of this chart right now, it's kind of setting up again here. The euro dollar seems to be very, very negative for the time being against this 2s5s, which seems to be now agreeing with the gold price falling. So that's setting up a little hollow in this space here, isn't it? That's setting up a hollow in here. And that hollow becomes a tradable opportunity for us to make some monies, doesn't it? What am I doing? A right hash of this crap, aren't I? It's setting up that hollow space in here for that dollar to be sold, the euro dollar to be sold. And then when we look at this, there's an opportunity to work into this sell side euro against the original buy side gold here. So you'd have bought gold here, made next to nothing. The gold seems to start agreeing. So obviously when that goes negative, it looks like an absolute guaranteed buy on gold. But when that starts dropping and that goes up, you start saying, okay, well, I've got long gold. What I'm going to do against that trade now is I'm going to start selling some euro dollars. And I'm going to sell the euro dollar at the top edge, and the euro dollars came off like a choo-choo. The gold got scratched out. You're now short euro dollars. You're now short euro dollars. Everybody understand that? Nice process, isn't it? Very nice process. And you can obviously add that process into your bond. If you want to trade the 2s5s, the euro dollar, and the gold market as a group of trades, then of course all you have to do is you do the exact same relationship with the red line and the dollar as well. So there's opportunities to do bond trades when the white line goes above, you know, on its own and things like that. You can start to recognize opportunities. So the gold is a negative correlation, Miguel. So what we're looking at here is that the orange line, which is the dollar, and the red line at the bottom edge here, which is the 2s5s, these should be negatively correlated. So this should be spending all its time at -1. All its time at -1. So when we start seeing one or two of them going above the top edges, something is horribly wrong. What we like to see is the white line going above and the orange line staying below, because that's telling us that the dollar is causing the gold price to do what it's doing. But that's obviously, that could be a bond, that could be a bond gold trade. So that could be a blue line spread. That could be a blue line spread. But it's just to give you a flavor. It's to give you a flavor of the idea behind these stories. It's about understanding those relationships in a mathematical framework. And based on that mathematical framework, we can start to recognize the opportunities in a mathematical sense, not just in a visual sense. I know some of you love the visuals. I know Nessie's a big lover of the visual or graphics. But in a mathematical sense, it's great for people who can try and quantify how much value is in this. And you can see that there is a lot of value in this. This is nearly up at 1.0, and this is nearly down at -1.0. There's a lot of value in this, whereas you can see that the value difference in this area here, for example, is a lot smaller. So we can start recognizing that value can be something really, really interesting, like this one, or something not quite so interesting like this one.